We start today's market talk. The only intelligent way to think about markets is in terms of valuations. Unlike goods and services, higher prices lead to more buying in equities. That is the only difference. So, starting valuations are the prime driver for long-term returns. So, if your starting valuations are high, then the chances of getting good returns diminishes. Market setup as I see it, central banks have the power to make sure by an endless supply of liquidity that market continues to rise. They will turn monetary policy loose at first sign of trouble, and we need to look at sectors where government wants to reallocate capital like energy transition, reshoring, PLI schemes, etc., to see where the focus is. Government should not pull back capex hurriedly in the forthcoming interim budget. This is a risk because uh, right now the government capex is biased in favor of road, railways, defense, ports, green energy, etc. and PLIs. Risk is interim budget generally is populist and fiscal deficit is much higher than budgeted 5.9% of GDP for 23-24. Hence, they may just pull back on infrastructure spending. The other aspect in India is that household savings are going into residential real estate, and so the private capex is not taking place. So residential real estate means also it goes into all the ancillaries like cement, steel, and cables, wires, tiles, etc. So these are things to be kept in mind. I'll cover about this railway capex subsequently. Narrative is becoming too complacent about long-term bullish trend in equities. With all the money coming in, there is a secular rise in prices in the equity market. So the market wants to go up all the time, and sentiment is just the another name for weight of the money. So with so much of money coming in, if the new equity is not coming in, so the prices of the existing equities just keep going up. The largest beneficiaries of these recent affluent India, news is categories such as leisure, jewelry, out of home food, healthcare, premium brands within all categories. So, premiumization narrative is sweeping even small towns. Uh, you can see from yourself how the premium liquor is being consumed. Electronic gadgets, televisions, fridges, smartphones, laptops, washing machines. People want to be associated with aspirational brands, jewelry, watches being sold at various outlets, and fast food. People are nowadays talking only about single malt whiskey, etc., hotels, holidays. So it is benefiting cars. Landmark Cars is a distributor of Mercedes in India. So it's a big issue. Now, this time we should be prepared for mixed bag in terms of Q3 results. Some pockets will disappoint, but we need to stay focused on long-term prospects. While initial results for Infosys, TCS, HCL Tech have been better than expectations. Now, talking about Polycab, Polycab was hammered by over 20% to a 6 month low now. So, with lofty valuations, the market was unwilling to take a chance. So, some funds have dumped all the shares in their HNI clients' account. So, it's wait and watch mode right now. TCS results were ahead of expectations on execution and margin. TCS sees a tailwind for margins because they have cut down the employee costs, they have reduced their manpower, and have improved the utilization of employees. Deal wins are decent in absence of mega deals, while Indian business is doing better due to the BSNL deal. And if you are looking at modest returns, then this is one of the stock to be bought in or hold because FY25 EPS is expected to be around 140, 145 and are giving it around 25p, 3600, 3700 is a fair value. Though one has to keep in mind that the dividend yield is good and they do occasional buybacks also. Titan, with a single digit market share in domestic jewelry industry, has a strong growth prospects going ahead. So you see, they are like a shark in the ocean because still the market share is pretty less, and there is again a lot of premiumization which is taking place in jewelry industry. Nobody goes to normal now mom and pop jeweler shop nowadays. Everybody wants to go to Tanish showroom and others like that. So it is one of the best stocks in retail space. 22% year-on-year growth. All segments except eye care are posting double-digit growth. They will gain market share in jewelry business due to shift towards organized segment and hallmarking, which has become mandatory now. They are going to international markets like Gulf and US. Titan added 34 stores, 18 Tanishq and 16 Mia. Mia is for working women jewelry. They are selling Taneria saris, and Carrot Lane posted 61% and 31% year-on-year growth respectively. Now it's an expensive stock, but with EPS of around FY25 expected to be around 50-54, it can easily trade at 70-80, which is its historical P. So a price of around 3,700 to 4,000 plus is highly possible. Persistent systems with differentiated capabilities and focus on AI has been a big outperformer on already. So it achieved last year 1 billion revenue, and they are eyeing around 2 billion revenue in 4 years, $2 billion. Revenue performance remains strong, and order inflows give confidence to justify these high valuations. Revenue growth is ahead of industry peers, and they are incubating generative AI internally. So they have recently announced collaboration with Amazon. FY25 expected EPS is around 180. So this is right now at 40p. So in my opinion, it is expensive, and we have to see how much is the Q and Q growth and what is the guidance. But it leaves no room for error. Now, certain technical aspects. This is US 10-year yield. If you see, it started from around zero point 0.5, which was the level in 2020, and it went right up to 5, and now it is correcting. It is now below the 200 EMA, so it is likely to go down. Now it is around 3.94. So, moment there is this talk about rate cuts and all, it will go down further. So, this is one of the major tailwinds for equities right now, lower interest. Brent crude again, it's having a declining trend line, and last week also it corrected. So it is now around 76, 78, despite all the problems with Red Sea and other issues. But it is not going up because the expectations from demand are not that much. Dollar index again, if you see, it is correcting. It took support at 200 EMA at around 100 and then bounced back. But it's again in a declining trend line, so it should also correct, and that will give a fillip to all the commodities because it is inversely proportional and all the emerging market currencies. Gold, it tries to bounce, but it gets into an issue at these price range of $20-70 to an ounce. So it had a positive week, but it reversed. S&P 500, this is the all-time high, so it is trying to head that. So once there is a clarity on US interest rates, it will going to go up. So this week was a green week for them. Nasdaq, it has crossed its all-time high, so it is looking up. It has formed a beautiful rounding bottom. So now it is expected to go up. Moment there is this news on rate cuts, plus the AI related and semiconductor related stocks are doing well. India's 10-year yield is going down. So if you can see, this week was a big decline, and it is expected to go down further. Moment there is a more clarity on inclusion of Indian bonds in the global bond indices. So there will be more money which will come in to buy Indian bonds. So the prices will go down further. So this is a positive thing, as this will reduce the real rates. Nifty. So if you see the weekly charts, it had a green week, and on Friday the Nifty finished near the gateway to 22,000, and it is, as we discussed, is likely to go up. On a closing basis, we have hit a new high, so there ought to be more now from here. And as I have shown you, this is the last swing, This is the second swing, and this was the third swing. So around 21,050, 21,000 should be the decent stop loss. So for all the people who are long, uh, the previous two swing lows can be used as a trailing stop loss. So 21,000 should provide support. Trend is strong and not in a mood to reverse. So if you see here, it has not formed from October onwards. The every week has been higher than the previous week low. So there is no need to really panic or something like that. Uh, Sentiment decides actually how much risk people will take or not take, and right now the sentiment is big, so the drops are expected to be less, and liquidity will guide as to how much the price shall fall during a reaction, because if there is a lot of money waiting in the wings, then it comes to buy at the lower levels. Right now, the market is overbought, but there is no sign of trouble. So even if it stalls for some time, there is no reversal signal. It will rebound back. Earlier week lows have not been broken since last week of October, as I told. So continue to participate till momentum plays itself out. Now, if you see here, from that dip it made on the Fibonacci extension, it has reached that 50% retracement levels now. So moment it goes to 61.8, that is at golden retracement levels, extension levels, then it will go up. Then 22,000 will be just inside. So don't be surprised if there is a gap up opening on 22 plus. So just keep invested, and then see what happens once it reaches those targets. This is the Nifty options data for the next week expiry. Interestingly, there are hardly any call writing. Call first set of major call writing comes at 22,300, and there is massive put writing. So you can see from yourself as to what is the direction people are taking on Nifty right now. Nobody wants to take a risk of being negative on the Nifty right now. Reliance, it was all getting stuck in this supply zone, but it has crossed that decisively in the last week, and it has had a breakout to all-time high. So it is expected to head higher. So remain invested, and this is one which has taken the Nifty also higher this week. So if you see this daily chart, it formed a beautiful rounding bottom, and from there it has broken out. So now the 3,000 level is inside, and it has broken out with good volumes also. So remain invested, and this is not a time to sell this thing, because it improves the sentiment and it takes that mid cap and small caps also higher. L&T is another stock which is part of the India story, and it is again remained positive this week also. So trading well clear about the 20 EMAs, the nearest moving averages. Bajaj Finance, it gets into this supply zone at 8,000 to 8,100. So let's see, it gave a bounce last week, but this week it consolidated. So we'll have to see where it goes from here. But these will all stocks which are still not gone to all-time highs will also bounce back, because their results are expected to be good. Nifty Bank had a negative week, unlike Nifty, basically due to HDFC Bank. So here there is no this momentum, but 47,000 proved to be a decent support last week, and it bounced back from there. It went up to 48,000 plus, but after that it corrected. So we'll have to see next week what happens. This is a daily chart. So if you can see, it is pretty volatile and going up and down. So it went below the 20 EMA but bounced back. So right now it is above the 20 EMA. So in the short term, the 20 EMA of around 47,500 should provide support. And if it trades above that, then it should be good. HDFC Bank, it faced resistance at this supply zone beyond 1700, and it's bounced back from there. So I'll watch for this level of 1605, which is the 20 EMA. and the results which are due next week, I think on Tuesday. So that will decide, though it is going into the results with negativity because everybody is short. So chances of bounce back are there in case the results are decent. ICICI Bank bounced this week and it has gone now above 1000 levels. So it is expected, let's see if it can now go and test that earlier highs of around 1050 odd. So if it goes there, that will take the bank Nifty up. PSU Bank
Tarun, ICICI Bank, why it is not participated in the rally? Every other Tom, Dick, and Harry has gone up and all, but this
okay.
is
Yeah. So what I thought about it, sir, in my understanding, the reason is that uh, in banking sector, people don't want to give any bank higher valuation as compared to HDFC Bank.
right.
So it is getting stuck at similar valuations in terms of price to book, which is forward is around 2.5 or so for FY25 to HDFC Bank. Hence, it is not moving up despite all its verticals and the performance being good. So this is one of the reasons why it is not performing. And if you see all the all the private banks, which are big banks, are below the HDFC Bank or somewhere close to that valuation. No, they don't want to trade anybody higher than that valuation. That is the key issue. So
But
that's why it is floundering.
the overhang on Bank is different. These banks have no such overhang.
Absolutely. But problem is that people are not ready to give them higher valuations. So that is the thing, though, despite their all results are very good. And it is now going, when the results were good, they did nothing happened. So now the results which are going to be slightly not good as compared to earlier times. Now, what do you say on these issues? Because now the NIMs are supposed to fall and all those issues. So, but the bigger picture, if you see it, you got to have these 3, 4 large banks in India for 4, 5 years if you want to play the India's story and growth of the economy and $10 trillion economy over the next 10 odd years. So these banks should become 3 times from here because they are the ones who are going to finance the whole thing, all the spending and all the consumption story and all the infrastructure is these guys who are going to finance. So it is just a temporary affair. But if you see the trend is higher, it is making higher highs and higher lows. So if you see this chart, it is making higher highs and higher lows. It is not able to break out. So that is the issue. Otherwise, there is nothing wrong with this bank.
Two banks which have given me tremendous amount of money in terms of put options is one is Bank of Baroda. I was quite bullish and it proved that I took a lot of risk in the Bank of Baroda. My last put was 220 and now I am making money in 220 put also. Similarly, Can Bank earlier on was kind of on a hold. Now it started moving up again. So that is also giving me decent money.
Yeah. So PSU banks we will see now. PSU banks. Now it is again similarly as you were saying, sir. Uptrend is there. PSU bank index it has broken above this rising trend line, and it will have a positive. It had a positive week, so all the major constituents are positive. So one of the main constituents is SBI. It had broken out above that all-time high of around 620, 630 odd. And let's see if it is able to trade, though it had a negative week. So it corrected from those levels and it closed at around 633, though it bounced back on Friday. So from 620 odd level. So we'll have to see this. It went to 620. So we'll have to see this stock. But the other banks, as you said, the other PSU banks, they're performing very nicely. This is the public sector enterprises index. You see, last week there was some profit booking here, but this is the strongest sector with all the money which is coming into this. So this should perform well. And there is no need to book profits in every sector where there is public sector enterprises. PFC for all the people who are, yes, sir.
Sorry for interruption. I was saying, you mentioned about that, the valuation of the other banks are being kept low, not to cross HDFC Bank, whatever the reasons might be, if it's true. Now, in that case, in case the HDFC banks results are not very good, it'll further come down. So, are you trying to say that it may happen that the ICICI Bank and the SBI also will further come down?
Private sector banks, sir.
Uh,
Yes,
the
sir.
ICICI Bank or Axis Bank.
Yes, sir.
So probably that may happen, that will further come down.
But there is a lot of difference between valuations of HDFC Bank, ICICI Bank, and Axis Bank. There is still part to go for Axis Bank, so
Okay.
that may not really correct that much. But because if the names are expected to be lower, and there is a restriction on lending by RBI, which is
Lending.
still there, hence the probability is. Of outstanding results are not there, right? So, and it also depends on the market position as to what position or what with what sentiment it has gone into the results. So that is the
No,
issue.
my point is, then will it be a time to accumulate like banks like ICICI Bank?
If it goes down to lower levels to 100 EMA or 200 EMA, it is a time to accumulate. These are the, as I mentioned to you, next 5 6 years, these all will double triple, because these are the ones who are going to lend for the basic growth of the economy and all that. So no economy can grow without the large private sector banks, and they are every day taking market share from the PSU banks.
Okay.
Hence, there is no competition from them. They may be consolidating right now, but that doesn't mean that their performance will go down. There is no doubt.
Sanjeev,
Okay.
the ICICI Bank
Yes, sir.
950 put option February or March is a good put option to make money.
Okay. I
Yeah.
mean, even to acquire also, I can sell put option, of course,
Same,
and
same.
then
I'm saying the same thing. No, you can 950 का put option बेच दो, आ गया तो अच्छा
okay.
है, नहीं आया तो
नहीं
प्रीमियम तो है ही आपका.
तो
Just see
डिलीवरी ले लो.
where is the 50 EMA. That should be the safest level to go long.
Where is the 50 MA कितना है?
ये तो मेरे पास तो वीकली चार्ट में है, बट वीकली चार्ट इज से यस 950 948, so that is what it is, so that should be the safe level. Okay, the PSC, I spoke about PFC. Now PFC, if you see, it suddenly takes a bounce and then consolidates. This is what it is doing every time, and now it has been consolidating. So just watch out. It has now come closer to that 200 EMA, or sorry, 20 EMA, 390 odd. So it had a slight bounce. So this is a time to accumulate these stocks, and they are still much cheaper as compared to other government infrastructure funding stocks like IRFC and IREDA, etc.
PFC 380 put is a good option.
Yes, sir. Now, Nifty IT, if you see, now I was talking about this for last few weeks. Uh, Now, last week was good, and now it has retraced to that 78%. So, probability of it testing the all-time high of 39,479 or that level is now very high. So, it has stopped exactly at 78% retracement levels on Friday, and few more momentum and few decent results, it should try to go for that higher levels now. So this is a sector which is in momentum right now. Infosys, if you see, it had, I was talking about this symmetrical triangle breakout. So it broke out, then it had consolidated, but last week it had a very decent bounce back, and now it is 1600 plus. So despite all the negative news and the slightly weak results, but since they were better than expectations, it has it had a positive week. Persistent systems, as I had discussed, it's again a very strong stock. And if you see on the weekly charts, it is on an up move, trading well above the 20 EMA. Hence, this is a stock to be not to be chased, but to be bought around the supports, which are around 6,500 or so. Mid-cap index, again, it had a slight a kind of a doji week.
Let me just enter. Persistent 6400 is a good put option, like you said, and three IT stocks which have made tremendous amount of money for me. One is this Persistent, the other is LTIM, and then LTTS.
Yes, sir. Yes, sir. The mid-cap IT stocks are likely to do much better as compared to the large-cap IT stocks. The only problem is relative valuation. Now, here, what is happening in mid-cap IT is that they are already expensive. So, the good results or the normal results are priced in. So, here the chances of negative surprise are more as compared to the large-cap IT, where the expectations were as it is not there. So, that is the only point. Mid-cap index, it is not corrected much, and even this week's low, if you see, was higher than the last week's low. So it has consolidated, and there would have been some kind of profit booking at these heights, but it remains in momentum, and these stocks will continue to perform. Similarly, with small cap index, similar things. It had a very small green week, but still it is positive, and trading from March onwards, they are trading well above and have nearly doubled over last year or so. This is one stock which is breaking out. So if you see this Dixon daily chart, now here from a declining triangular pattern, it is breaking out. So on Friday, it has broken out. So this is one stock where you can go long around that 6,300 levels, which is the 20 EMA. So this is giving decent bounce now from here. The other stock.
Tarun, just one sec. What do you feel about First Source Solution? I have not handled that stock. I wish to, start handling that stock.
Well, it is a BPO, right? It's a BPO. It's a BPO business. So it's got nothing great. Only thing is that the cost of because of the services provided and the cost of labor is cheap, so it will continue to make profits. But it is not a very stock which is likely to bounce back. Plus, I think the price is limited, so it is traded excessively. So it is a favorite of the traders, like that. But
right.
It is like that.
Thank you.
So there is no distinguishing product it makes, or it is getting into something. It's just a BPO business.
Okay.
The other stock which is likely to do well, and it is again breaking out from this declining trend line and the declining triangular pattern, is data patterns. So if you see here, it has broken out from here. So if it crosses 2000, then it will head to around this 2200, 2100 levels. This is basically does this the simulators for defense kind of thing. So this is one more stock. No, sorry. I'm not 100% sure what is the business, but just see this. This is likely to do well. Now, the few stocks I will cover. One is HDFC AMC. Now, there is a big opportunity for them because they have the opportunity to tap the distribution channel of HDFC Bank and capitalize on the customer base. You know how aggressive the RMs are nowadays. AUM growth of 24% year on year continues to be driven by equity, which is 45% year on year growth, and balanced, which grew for 28%. So that is roughly 63% of or 64% of the total AUM, which is basically equity oriented and has higher margins as compared to debt and liquid. Asset mix in Q3 FY24 further shifted towards equity at 58% of the total AUM, which is relatively better than the industry at 53%. So their asset mix is better. AUM market share stood at 12.5%. So this total AUM, industry AUM of mutual fund is now 50 lakh crore, and they have reached an AUM of around 5.5 lakh crore in FY24. So they have a big market share plus credibility associated with them, because people who are putting money in any mutual fund want their money back also after whatever duration they are going to invest in. So they want some credibility and good name. SIP flows in Q3 FY24 stood at 2630 crore, growing 67.5% year on year, majorly led by improvement in performance of funds, focus on distribution channels, better engagement with customers via marketing and communication. So their SIP flows are good. So you can see from here, 2630 out of 17,000 crore is their SIPs. And it gives them revenue visibility, the SIP. HDFC AMC remains the top performing fund, rank 1 in 1 year and 3 year bracket. With size, total expense ratio for funds like HDFC Balance Advantage Fund reduced from 1.52% in December 22 to 1.42% in December 23. So they have reduced their total expense ratio, so which will attract more people to their funds because the cost to the customers reduces. And share of unique customers has enhanced from 17% to 21% now. So for this quarter, so which is decent. Now let's see their numbers. So they had a revenue growth of around 20% year on year and 4.4% quarter on quarter. Expenses quarter on quarter went down. And if you see the profits have increased by 29%, profit after tax 32%, operating income has gone up by 25%, and more digitization it will help. And so this is the breakdown. So if you see, equity is 45%, balance is 28% year on year growth, which they had. That 13 liquid, they went down because people would have withdrawn money. So their growth in all the categories year on year and month on quarter and quarter has been good. So if you see their financials, this is in millions of rupees. So they are expected to do around 3,000 crore of revenue in FY25. And so if you see, their core EPS is expected to be 79-80 rupees. And you can give them around 40-50 P. So it can trade anything between 3,500 to 4,000 rupees. And AUM, as I told you, is right now is around this thing. This is in billion. So this is 53,000 crores right now, and it is expected to go up. Now, if you see the share of their equity and balanced portfolio, it is increasing now quarter and quarter. It has reached around 38% equity and 20% balanced, and others like liquid, debt, etc., are reducing. So that is good because that leads to higher margin. SIP AUM is also growing, as you can see, so which is again good. This is their chart. It's a reach around 3,400. Results were decent. So mostly these are priced in. So once it dips to this 320, 3250, 300 level, this is a stock to be held for long term because this is a clear proxy for the India's financialization narrative right now. Because if more and more money is going to go into equity, this is a medium to invest this money. Now, the other interesting stock is Kirloskar oil engines. Why am I covering this issue is because, in my opinion, Cummins is expensive. So this is the second best in terms of generators. It is positioned well in both power generators and industrial markets and is ramping up its distribution and export portfolio. Demand has been on an upswing with strong traction in sectors such as data centers, commercial and residential real estate, hospitality, and manufacturing. Demand for gensets will continue to sustain till the time 24-hour grid source power availability is achieved. But that will take some time because the demand is increasing exponentially. And demand for this CPCB 4 plus compliant products is seeing a healthy improvement in regions such as Delhi NCR, where emission norms are more stringent, and they are working on this issue. The company's strategic focus on expanding its aftermarket and export bodes well for long-term growth. So they are also into aftermarket services because it is not after 1 or 2 years of having a generator, then you start looking at maintenance and other issues. They have greater than 400 service outlets across India, connected through digital platforms, and greater than 3,000 trained personnel. So that this service background provides a formidable barrier to entry. They're catching up with Cummins on gross margins, but overall margins of Kirloskar oil engines is lower than Cummins, basically because of the higher sales which are there in Cummins. So the leverage plays out in that side. There is a big market for the environmentally compliant products with wide range and strong distribution network is, as I discussed, is favorable. They are nowadays people are looking for higher horsepower sales, which is above 1500 kVA and above, which have higher margins, and so they are working on that. And higher level of electronic content in the new gensets increase the level of complexity and scope for aftermarket income. Now this is their revenue. So if you see, this is in millions. So they're expected to do around 4,800 CR of this thing. So they are growing at revenue this year. They are growing at around 15-16% now after initial big growth, but that should be steady now from here. And gross profits are also expected to increase. Uh, Margins are expected to improve now from 10 odd percent to 11 to 12%. So that should help the bottom line. And PAT is expected to go up. So PAT is likely to improve by 20 to 25% over the next 3-4 years. So that should be good thing. And margins are also expected to improve. So if you see, they are expected to do a revenue, or sorry, EPS of around 30 in FY25. That is expectation. So they can easily trade at around 850 to 900 right now, as per this EPS. And if the demand sustains, uh, the right now for so this is cheap 22p right now for FY25 on earnings at the present value. ROE, ROCE are expected to improve now. They are going into 15% plus levels. Return on invested capital is also going to go up, and they don't have much of debt, so that is stable. They launched 37 diesel genset model across CPCB 4 plus compliant product range. So for all categories, they launched number of models up from 3.5 kVA to 750 kVA, and gas gensets compliant also were launched from 5 to 250 kVA. So that is so they have wide variety, and now they are going into that 1500 kVA plus range. Now, if you see, the market share is much lower for them versus Cummins. Export share is much lower. So Cummins is a big leader, but these guys are increasing their market share while Cummins it is going down. And distribution is also lower as compared to Cummins. Now Cummins is a big player in this field. Now, if you see the Kirloskar oil engines, it has it has always traded above the 50 EMA and take support from there. Now it has gone up. So if it declines to around 20 or 50 EMA to around 620, 650 levels, this is the time to accumulate these stocks. This stock for long term. The last stock I'm going to cover is Titagarh Rail System. This is a very interesting stock because I went through all the three stocks of this category, which are supplying wagons and the other parts requirement, coaches, etc. for railways. This is the largest wagon manufacturer, 28% market share in FY23, and is slated to immensely benefit from Indian Railways' plan to spend $750 billion, that is 62 lakh crore over FY22 to FY30 on rail infrastructure. Now, here I wanted to point out here that this is the plan, but in the last year's budget, the railways allocation was 2.41 lakh crore only. So how they are going to get so much of money? They're going to spend double the money over next 6-7 years is doubtful. So one has to keep that in mind. They have a strong order book of 28,200 crore, that is 28,200 crore, which provides them revenue visibility for next 4 years. On the freight side, the company plans to expand capacity to 1,000 wagons per month from 700 currently. and it has signed a contract uh, with Indian Railway to supply 8,000 wheels per annum for 20 years. This contract they did with Ramakrishna Forgings. So if you see, they are planning to create a facility capacity to supply around uh, 12,000 wagons per year. That is the kind of demand which is expected. They are also increasing their passenger coach capacity from 20 cars currently to 70 cars per month. So there is a huge demand for this Vande Bharat and other trains. They are also planning to execute orders for 408 metro coaches. It's the only company which produces aluminum wagons with its associate TRSL Pharma, which is an Italian company. And expectations are that 35%, 43%, and 54% CAGR would be there in revenue, EBITDA, and PAT for the next 3 years, respectively. Now, there are basically three triggers for the railway stocks or this stocks. First is freight wagons infrastructure. Second is metro systems, and third is high-speed Vande Bharat trains. Now, they got an order for 1280 Vande Bharat coaches, and another 8,000 coaches is to be awarded by Indian Railways over the next few years. So that is one big order. For Vande Bharat, they did a tie-up with BHEL. So they were the L2 vendor. The L1 was RVNL, with a Russian company. And with RK Forging, they are manufacturing, as I told you, the wheels. Uh, Indian Railways is keen to increase its logistics share from 27% in 2022 to 45% in FY30. So for that, they require wagons. And this, once they're talking about this aluminum wagons, they have lower weight, so they reduce the energy and cost for traveling. So what is planned is to add 30,000 wagons per annum for the next 5 years by Indian Railways. Now 30,000 wagons means 12,000 they are planning to have a capacity to produce as of now out of that. So there is a revenue visibility for long time now. They are also got contracts for Bengaluru, Pune, Surat, and Ahmedabad Metro. So that is the second revenue field. And out of the 23,000 odd crore contract which they got for Vande Bharat, 9,600 crore is for trains, and balance is for maintenance over 35 years. So, but I would be watching for the railway budget, how much is allocated, because everybody is creating capacity and plans are good, but who is going to give the money is the key issue. Another issue is that there is a dedicated freight corridor is being built, western and eastern, and is likely to be completed by June 24. Now, so that should be a good revenue thing for the freight wagons. They also have a partnership with ABB to supply propulsion system for metro projects. So that is another thing which helps them. Now, so if you see their segment-wise profile, freight rolling stock and passenger rolling stocks, they have two segments. Rolling stock, flat wagons, hopper wagons, tank wagons, box wagons, then components, forged wheel set, cost bogies, couplers, draft gear, CMS crossing, etc. And for others, they do this some kind of shipbuilding, bridges, defense, etc. Rolling stock in terms of passenger rolling stock, semi-high-speed trains, high-speed electric locomotive, etc. Propulsion and electric equipment, which they are doing now with ABB, propulsion system and traction motors, and services is the passenger rolling stock maintenance. So these are the uh, uh, basic compartments or which are there. They are, I think, based in Calcutta with a setup in close to Delhi also, Bharatpur also. This is their revenue. So if you see, this is in billions, rupees billions. So they are expected to do very well over the next few years, with the PAT is expected to nearly from what is there in FY23 is expected to it's expected to grow 3 times now from here, and EPS from 12.5 is expected to reach around 32 and FY26 is expected to be 42 odd. This is a kind of growth we are looking at, exponential growth for them. So the revenue growth is expected to be for next 2 odd years is expected to be 30% plus, and then because of the initial pace of growth, EBITDA growth is again expected to be 40% and then taper down after something. Gross margins are expected to remain around 20%, EBITDA margins around 11%, PAT margins around 8%. So there, all the ratios are decent, and PE is for FY25 they are presently trading at 30 PE, but this kind of growth they can easily be trading at a higher PE, and so all the things are good. Only thing is execution and orders. So that is the risk. Now, if you see revenue growth, again, you can see how good they are expected to be, plus EBITDA growth, EBITDA margins expected to be remaining at a 20% as the volumes grow. So margins are expected to decline, and EBITDA margins and PAT growth again and the margins are expected to remain decent, and they are expected to grow exponentially, grow 3 to 4 times now every year. If you see here, they are adding 1,000 crores to the profit. So that should reflect, or will start reflecting in the uh, in the in the price. Now this is the comparison of freight wagon industry. This is Jupiter Wagons, this is Titagarh, and this is Texmaco. So if you see here, their respective how much revenue they are doing. So if you see, roughly they are doing similar revenue, roughly around 3,000 to 3,600, 3,500 odd crores. So revenue is same, and then it is expected to increase for all. Revenue growth is expected to be from 30 to 60% for all, and margins are also expected to be in 20%, and all expected to improve. Return ratios are also expected to improve. So if you see here, all of them are generally at similar valuations, and forward P, if you see, they are all at 28, 27, 30 odd times. So in my view, all of them are expected to do well, and none of them is expensive or cheap as compared to that. The only thing is that ROE of Texmaco is slightly lower as compared to rest, so their profit should be lower, and that is the reason why it is at lower PE as compared to the other Jupiter Wagons and Titagarh rail system. But we'll have to study these stocks in detail as to what is the business verticals they are getting into, and what is the revenue guidance and all those issues, and what capabilities they are able to execute and all that. Now, if you see the chart, Titagarh rail system since March last year, has had a vertical rise, and it has nearly become 3x now in terms of price, and it went to its 20 EMA, and then bounced back and then corrected from there. So this is a stock to be accumulated on all dips. So all bad days, like if you see here, in October it came to 750 odd levels, that on 26th October correction, and here again there was a correction in September. So on all bad days, these are the stocks to be accumulated, as I have mentioned here, not at such high levels. So this is the only thing. So I have finished. We will take questions now.